Okay, if I could have your attention, please. Thank you. This one took quite a while last year, so we want to go through it. We'll go through it as we can. If there's anything that I say, this is about raising capital, which is something that generally most of you might need to do at some point in your lives for something at some point, probably your business. If there's anything that I say that you don't understand, don't be the person who, out of fear and anxiety over your status and how others are going to view you and so forth, sits on your hands and doesn't ask the question. Okay? Can we have that agreement? Yes. Great. Thank you. So, we are going to start at the basics, and we're going to go through it very quickly because you guys are so smart, and a lot of you know this already. Some of you guys have backgrounds as investment bankers, and you know, just stick with me. Some of you guys might not know any of this. So we're going to talk about just basically company structure. So company overview. So for the purposes of this presentation, some of this we're going to talk about finance, we're going to talk about capital raising, we're going to talk about accounting. Okay, so we're going to talk about all these things because you have to have a good idea about all these things in order to make that pitch in the presentation for raising capital. So in any company, we're going to talk about two different kinds. We're going to use these words initially interchangeably, and then we'll kind of talk about later, time permitting, the differences between a corporation and a partnership. Okay, these are different forms of legal structures, corporations and partnerships. We'll talk about the differences between those two later, but I want to explain that there is a difference. So when you use these terms, don't use one word when you should use another word. Corporation and partnership. Now, for general purposes, we can lump them all into the category, and I'll just use the word company. But a company can mean a lot of different things. It could be a corporation or it could be a partnership. Corporations and partnerships are actually a reflection of tax status more than anything else. Tax status more than anything else. So I'm going to use the word company, but just so you understand that company could mean a lot of different things. All right? So a company, I'm going to go through some of the people that are involved in a company, right? In a company, you have founders or co-founders. This is the person that starts the company, has the idea, says, I've got a great idea, I want to start the company. You are the founder. If you bring on somebody else to do it, they are the co-founder. Matt and I are co-founders of Sovereign Man, as an example. In many companies, particularly if it is a corporation, a specific legal entity based on its tax structure, it has what's called a board of directors. The board of directors of a corporation, big companies have this, Apple has it, Google has it, now called Alphabet, General Motors, and so forth. These all have boards of directors. The board of directors technically has the responsibility to run the company. They direct the company, hence the word director. The board of directors directs the company. This is a group of, the boards can vary in size. It can be one person, it could be 3 people, it could be 15 people. Usually it's an odd number because they have to vote, and so sometimes it has to be a tiebreaker. But the directors have the responsibility of running the company. They set the strategic vision for the company and say, here's where we want to go. And then the responsibility to execute that vision falls on the management. The head of the management is the chief executive officer, whose responsibility is to execute the vision that has been outlined by the board. Now, if you have a really good CEO, the board doesn't have to do really any work because the CEO comes in and says, here's what we're going to do. Here's my vision for the company. Here's what I think we should do. And a lot of times in companies, the CEO is on the board of directors. And the CEO will say, here's the direction we should go, here's my plan on how to execute that, here are my milestones, and so on and so forth. So what Jeff was talking about setting these 90-day goals and 12-month goals and so forth, these will be things that people at the higher levels of the businesses do. Management executes that on behalf of the board of directors. And the last group that's involved there's one more group. These would be, sometimes companies have what they call board of advisors. Okay, this is different than the board of directors. The board of advisors are people that are not necessarily connected to the company, but they are subject matter experts in the field that the company is involved in. So if you're in, let's say, the royalty space, and particularly in the entertainment business, then there may be a board of advisors of people that are in the entertainment business, prominent entertainment lawyers and maybe even musicians and things like that to advise the company. They're not directors, so they don't have any actual control or legal authority over the company, but they're there essentially as almost permanent consultants to, from time to time, provide advice and say, that's a good direction, we think this will work, or we don't think this will work. So advisors, sometimes several advisors would be the board of advisors, board of directors that has the legal authority to bind the company, to enter into contracts, to direct the company, to set the company's strategic vision. Management, led by the CEO that's responsible for executing that plan. And of course, the last group is are the shareholders. The shareholders are the people that actually own the company, So at the end of the day, the shareholders, they have the ownership, they own the assets, they own the equity, they own the profits. We'll talk about what all this means. And in many respects, particularly with startups, these are all the same people. You start your company, you're the founder, you're the director, you're the shareholder, you're the CEO, you're all these things. But as your company gets bigger and bigger and bigger, these start being different people. You start having real directors. You start having separate advisors. You start having people under you with management. You might even hire a CEO. You'll bring on other directors and so forth. These start being different people. In the beginning, it's basically all just one person. But when the company expands, you become more successful, these start being different people. In many respects, as a catalyst to growth, you might have to bring on some more people. We're talking about raising capital. It can be very difficult to raise capital when you are all of these things. As an investor, that means there's a lot of risk because there's a single point of failure, you. And if something happens to you, then I know that my investment is basically finished because you got bored, or you got divorced, or something happened and you just lost interest, or something went down and you weren't able to fulfill all of those roles. And it's not sustainable to fill all of those roles forever and ever and actually have a growing and successful business. So eventually those roles with a successful business will change and there'll be more people brought in to fulfill those roles. We're going to talk about basic accounting. So this is important to understand with capital raising. Accounting is a torturous little science that was actually invented by a monk who obviously had not gotten laid in a really long time. So he came up with this idea of accounting. It makes sense. There has to be a standardized way to determine what you have, what you own, how much money you're making, and so they put together these rules to determine that. So everybody's essentially using the same playbook, the same rule book, and so we can look at somebody's accounts and we can all make a determination of, okay, this is what the company owns, this is how much the company's making, because they're all essentially playing by the same rules, and so there's no translation that's necessary. And that's what accounting really does, is it provides us with some basic rules. We don't have to get into the differences between, for example, cash basis and accrual basis, but I'm going to explain a couple of the probably two most important statements in accounting. Financial statements. Every company should have financial statements. The two most important financial statements that we'll talk about, there are four fundamental financial statements. The two we'll actually talk about are your balance sheet and your income statement. Okay, so balance sheet, you guys may have heard of this before. Balance sheet. Okay, so balance sheet is comprised of fundamentally two things: assets and liabilities. Okay, someone tell me what an asset is. Not an example of an asset. What is an asset? Okay, I'm going to steal Robert Kiyosaki's definition. There's a very complicated accounting definition for this that was invented by a lawyer. Robert Kiyosaki's definition of asset, which I think makes a lot of sense, that everybody can understand, is an asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. So you guys gave some good examples: cash, real estate, expensive watch is an asset. Every one of you essentially has your own balance sheet. It's your statement of net worth, essentially. If you own your own home, if you have a car, if you have cash in a bank account, if you have gold, if you have any of these things, those are all assets. If you have, on the liability side, if you have student debt, if you have a mortgage, if you have credit card debt, etc. These are all liabilities. Josh?
You put expensive watch in the asset column.
I did put expensive watch in the asset column.
You justified it as anything that puts money in your pocket. Are you saying that the expensive watch
Puts money in your pocket, or potentially could put money in your pocket. I can go and sell this for a lot of money if I need to. So I can convert it into any one of these things. But theoretically, on the other hand, if if you've got a car that you might think is an asset, but it costs you $1,000 a month because it keeps breaking down and so forth, I would argue that that's probably a liability. I'm sorry? Unless, okay. Who had a question? Stephen? The car is the asset, the car loan is the liability, right? So the idea is that you want your assets to be greater than your liabilities. Make sense? The difference between the two, this is the fundamental equation of accounting, okay? The difference between the two is called equity. Equity, that's the difference between the two. Unless you're a bank, in which it's called capital, but we're not going to worry about that, only Chris. So the idea is that, do we want this number to be positive or negative? Positive, unless you're a government, in which case you don't care. So we want assets to be greater than liabilities. So we have, 1,000 pounds in cash and 50,000 pounds in real estate and 10,000 pounds in expensive watches, and we've got 5,000 pounds in student debt and no mortgage and no credit card debt. So our assets are way bigger than our liabilities, which means you have a positive net worth. Okay, businesses are exactly the same. So if we were to do the same example for business and say, okay, what are examples of business assets? It could be all these things. Usually, unless you're in the watch business, expensive watches aren't a business asset. Could be intellectual property. If you have patents, if you have software, these sorts of things, and we'll talk about that. We'll talk about valuations and things later. Cash is clearly a business asset. You see these things on people's balance sheets, things that they call PP&E, property, plant, and equipment. A lot of times businesses will add up all the values of their computers and their desks and all these sorts of things, and they'll get to assets. Other examples? Oh, okay. Okay, I thought you had a... Okay, other examples of business assets? Okay, could be licenses. Yeah, that's what I was going for. Now, there are essentially two types of assets, tangible and intangible. The difference between the two is that tangible is something that I can hold in my hand so that people can do something else with it. Tangible is something I can hold in my hand. Cash, property, desks, markers, all these things are tangible assets. Tangible assets. Then there are intangible assets. Intangible assets in accounting terms, they use things like goodwill, which in many cases can be the value of your brand. Donald Trump is famous for greatly valuing his brand. The name Donald Trump carries a lot of weight. He slaps his name on everything. Trump this, Trump that, Trump ice, Trump steaks, Trump balls, Trump everything, right? And in his mind, putting Trump on something makes it worth more. And you know what? He's right. If you could put your name on something and it immediately goes up by $1 million, you could make a pretty strong argument that brand, that goodwill, is actually worth something, right? So this is an intangible asset. Now, the interesting thing about all these is that sometimes they can be hard to value, right? Now, I can easily value the amount of cash that I have in the bank. I just have to look in my bank statement. I ring up Chris. It's pretty simple, and it goes down to the decimal point, okay? The trouble sometimes in valuing these things, if you're dealing with foreign assets and various currencies and so forth, it can be a little bit hard to know exactly what they are. If you own a lot of, for example, stocks, which go up and down all the time in any given day, one day we're up this, next day we're down, it'd be a little bit hard, but you can always sort of take a snapshot of where things are exactly right now. Generally, a lot of tangible assets, you have this ability, particularly when there's a market. Cash, you always know how much cash you have. You can get the value of your security. Even real estate, which is relatively illiquid, We have a general idea of how much our real estate is worth because we can look around in the marketplace. How much is the value of the name Donald Trump? What is that worth? Who knows? And he's actually said, he basically just pulls a number out of his ass. So when he says he's worth, billions and billions of dollars, it's because a lot of that is in his brand value. It's in his brand value, which is a number that he just kind of makes up. And a lot of people do. The value of a lot of intellectual property and things like that, these can be a little bit more difficult to value because there's not exactly a marketplace, because there's no royalty exchange for Donald Trump's name, at least not yet. But that would definitely get us to $1 billion. So balance sheet, assets and liabilities. In your business, you have to be able to communicate to investors your balance sheet. That's going to be a thing that any sophisticated investor is going to want to see. Is they're going to want to take a look at your balance sheet. And essentially, you have to list all of your assets, both tangible and intangible, as well as your liabilities, and we get a sense of the equity. In a lot of cases, startups actually have negative equity. You might have to have taken on a lot of liabilities. Maybe you don't even really have any assets at all. You've got 0 assets and you've got a few liabilities because you owe some money to a supplier or something, all kinds of things, and you might actually have negative equity. It's not that unusual. It's not a great position to be in, obviously. You want to have positive equity. You want to have positive net worth. Ideally, the bigger this number, the better. The more your business is worth, right? So this is one. The other is the income statement. The income statement, I'll do it over here. I feel like Jeff should be doing this part. So, the income statement is income and expenses. Pretty simple. The difference between income and expenses is what? Profit. Profit. Yeah. Now, in accounting, there's a lot of very technical terms about gross revenue, net operating income, EBITDA, all kinds of things that we can really, these are all individual rabbit holes. But essentially, people know the term profit. If you want to be very technical and use a more technical term when you talk about profit, use the term net income. Don't ever say net profit. Don't ever say net profit. Never ever say net profit. Net income. Net income. Because it doesn't exist. There's no such term as net profit. Net profit is what people say when they don't know what the hell they're talking about. Okay? So there is no such term as net profit. Net income is the appropriate accounting term. Net income.
Is it the same thing? No.
People make up a term. They've made up a term. They say, oh, my net profit is this. And there's no such thing as net profit. It's net income. Net income. So net income is the same thing as what we normally consider to be profit. We say corporate profits and the Facebook profits and so forth. They're ultimately talking about is net income.
So that's after expenses.
That's after everything. That's after that. So the way and the way companies work is you've got your income, which you could also call revenue, right? So this might be you made a sale, you closed on a contract, and so forth. In accounting, remember we were talking about there's these different rules, and in accounting they have something called revenue recognition rules, when you're allowed to actually count something as revenue. This is why accounting is really weird, because it defies any of our normal conventions. If you pay me for something and I put that money in my pocket, I think, great, I just made some money. But in accounting, you might not actually be able to consider that revenue. I have to deliver a product to you first. I have to fulfill the full obligation. For example, one of our businesses, Sovereign is a subscription product. So if somebody buys a subscription from our business and they pay us a couple $100s for that, I go, great, okay, we have a couple $100. But it's not technically revenue because I haven't delivered the full 12 months of that subscription to them. So technically I have a liability to the customer. I have an asset, which is cash. I have a liability, which is their subscription. That's a rabbit hole. So, income. So we have revenue, then we have expenses. What are examples of expenses? Could be, yeah. But generally, in business, they talk about, in accounting, they'll talk about operating expenses. So, operating expenses might have interest on a loan, which is definitely an operating expense. We'll have salaries. We'll have rent. What else? That's right. Does anybody know what SG&A stands for? Selling General Administrative, yes. Selling General Administrative expenses. They lump a lot of things into these categories in accounting, just like I was saying on the balance sheet, PP&E, they put property, plant, and equipment, they'll just put a big number there, and they don't really drill down a whole lot further. SG&A, these are selling general and administrative expenses. So, but these are examples of the kinds of expenses that you might have, normal expenses in a business. A lot of expenses have to be what they call being capitalized. We're not going to get into that. And then the difference between the two, if we get here, the difference between the two would definitely technically be considered pre-tax income. And from your pre-tax income, then you pay tax, and then at the end of that, you get to your net income or profit. Make sense? So minus tax, net income. So you have to be able to communicate these numbers. You have to be able to talk about your equity. You have to be able to talk about your net income. You need to talk about your income and expenses, your assets and liabilities. You need to be able to communicate these. That doesn't mean that you personally have to try and put all this stuff together. There are a lot of really cheap accountants out there. This is pretty easily outsourceable. This is not something you should be spending dozens and dozens of hours on when you should be growing your business. But you need to be able to understand what these numbers mean. If your accountant gives you something and you don't have the foggiest idea what net income is, or whether a positive or negative equity position is good or bad, you need to understand these things, because you at least at a high level, you don't have to be the subject matter expert, but you have to understand this at least at a high level, because you need to be able to communicate these to investors. Does anybody have any questions on the basics of our accounting? Yes?
Your membership, your database counts as your asset.
Absolutely. Absolutely. It's a huge asset. We've got hundreds of thousands of people in our database. Of course, it's an asset. There's Bill Gates famously says that he wishes he could count his employees as assets because they're all so valuable, and certainly something that puts money in his pocket. And he's right, but in the case of the rules of accounting, generally accepted accounting principles and international financial reporting standards say, no, Bill, you're not allowed to put your assets or your employees in your asset column. But sure, that would be an example. Is that so? A customer database, is that an example of tangible or intangible asset? It could be either one. I would generally put it as an intangible asset. A lot of digital assets in general would sort of be automatically considered intangible. If you happen to be in the business, I kind of consider it a tangible asset just because I can't feel it in my hand. I know exactly what it is and what we can do with it. But it's not. Defining something, whether it's tangible or intangible, is less important. The most important thing to understand with intangible assets is people tend to include things like brand value and so forth. A lot of companies really inflate the value of their assets because they put so much, they put a very high valuation on their brand and these sorts of things. And so when I look at businesses, I usually discount all that stuff and I start looking at the real tangible assets, not the intangible, not the brand value or any of those sorts of things, because I think they're irrelevant.
Would you call intangible maybe your free membership intangible, like you've got something?
I'm probably not a very good example. Cyberman is not a very good example of these things. But again, whether you classify something as tangible or intangible it's not really relevant. It's not. If you hand me a balance sheet and you say customer list, tangible asset, I'm not going to throw it down in disgust and say, you have no idea what you're talking about. It's not really that big of a deal. Yeah. If you consider your real estate to be intangible, I'm going to presume that it was a typo, because you're an intelligent person and you would know better. Yeah.
When you have when you look at a company that sells like info products and stuff like this, you have to actually consider them their value as intangible as well, because they might not have any tangible assets actually, because they are totally online.
Right, that's what I was saying, is that generally digital assets would be considered intangible. Yeah. But there's these accounting rules, many of them were actually invented centuries ago. So the rules around digital assets are still being figured out by everybody. So again, I really wouldn't worry about the classification between tangible and intangible. It's something to know about, but not something to really give a whole lot of thought to or stress out about. Okay, I'm going to move on. So now I actually get into the part about raising capital. So raising capital, again, it doesn't matter what you're doing if you are, if you're running a charitable or philanthropic enterprise, if you have a business, even for personal needs. We see these guys running around on GoFundMe saying, I want to go to Spain and somebody pay for my trip because I'm too lazy to figure out a way to pay for it myself. And, I'm just going to rely on the generosity of other people. I'm sorry? I think it's a pitiful use of crowdfunding. I'm lazy and want to go engage in my leisure activities, so I'm going to just tread on other people's generosity and go and do that. I think that's pretty lame myself. But so any of these sorts of ideas essentially may require raising capital. A lot of people think that they need to raise capital when they don't really need to raise capital. Some people do, some people don't. And there's an important part about this idea in knowing really your business model, identifying that business model, being the architect of that model, and making the determination of whether or not you need to raise capital, at how much, at which level, at what point in the growth of the business. First, we're going to talk about, though, a couple of ways to do that. So, to keep things simple, we'll talk about debt, equity, and bootstrapping. Okay. So one way you could raise capital is to borrow the money. This is ultimately debt. If you borrow money, it goes here. Debt becomes instantly a liability. If you go to the bank, if you go to an investor, please don't go to your family and say, hey, I need to borrow some money. Then what happens? The way this actually is reflected, you say, I need to borrow 50,000 euros. So you now have 50,000 euros in cash, and you have 50,000 euro debt. Simple. On your income statement, you would have however much you're paying in interest. This is an expense of the business. So the interest would be deducted on the income statement, but your balance sheet would show 50,000 euros in debt, 50,000 euros in cash, asset and liability. Okay? So the way these things work in business, the debtor, the creditor, the person who loans you the money, the lender, always gets paid first. So this is a very important thing to understand. With your income statement, you start with revenue. Then you have your expenses. You pay your salaries, you pay your rent, you pay all these things, and you also pay the bank. You pay the interest. You pay the investor who loaned you the money because it's debt. Just like credit card debt, just like student debt, just like mortgage, just like a car loan, the bank, the lender, always gets paid first. Always gets paid first. If there's anything that's left over, this goes to the shareholders. Anybody that owns equity, has equity, a stockholder, a shareholder in the company, they get paid last. The lender gets paid first, the shareholders get paid last. Does that make sense? Now, the lender, if you come and you say, hey, I need 50,000 euros, what's going to happen? They're going to go, oh, great! I've been waiting for this opportunity to write a check for 50,000 euros. No, of course not. Of course not. They're going to want to look and see, okay, how risky is this company? They're going to want to look at your balance sheet. If you need 50,000 euros and your equity is negative, hundreds and hundreds of thousands of euros negative, and you want to borrow 50,000 euros, and your income statement shows that you have negative net income, that you're losing money, this looks like a pretty risky proposition. A lot of times when you want to borrow money, the lender wants you to post collateral. They want you to put up an asset. They say, okay, I'll loan you 50,000 euros, but I'm going to hold on to your expensive watch. Or I'm going to put a lien on your property. Or you have to give me the title to your car, or something like that. So that I have some security, so that if you don't pay me, then I have this asset and I'm going to keep it. Okay, this is collateral. So this is basic idea of debt financing, is that again the banker or the lender always gets paid first. Another way to raise capital is by selling shares in the company. So if you have a company and you want to raise more money, you could say, okay, I want to raise 50,000 euros, and you say, I'll give you 10% of my company in exchange for 50,000 euros. So now I get 50,000 euros in the bank. I have 50,000 in assets because now there's 50,000 in cash. I actually don't have a liability anymore. Why not? Right. Yeah, because they didn't actually loan me anything. There's no money coming out of my pocket. There's no interest that I have to pay. There's no expense that I have to pay now. What's actually happened is that the stockholder equity went up by 50,000. We don't have that part of the balance sheet on here. But essentially now you have a shareholder. Shareholder is a co-owner of the business, and as a co-owner, that means they have a share of the assets, they have a share of the profits or the net income, and so at a certain point, then the company, if it's profitable, if it's generating positive net income, it will continue to build up a cash position. At a certain point, the company, the directors of the company may say, you know what, let's actually distribute all this cash that we have and give it to the shareholders. After all, the money belongs to the shareholders. And so we're going to pay out this share of our profits to the shareholders. And you, as a shareholder, would be entitled to that. If the company gets bought out, it's what everybody thinks. Amazon's going to come along and buy my business any day now. So when Amazon comes along and pays you $100 million for your business, and if somebody owns 10% of that, then they're entitled to 10% of that $100 million. They are an owner, just like you. If you used to own 100%, now somebody else owns 10, you own 90. So for an entrepreneur, this is usually a really emotional event for them because they're thinking, of course, every entrepreneur thinks that their idea is worth hundreds of billions of dollars and they're all going to become wildly successful beyond imagination. So they think that every little tiny share that they give out is just going to be crucial and it's going to just absolutely bankrupt them and they're giving up all this money and so forth for every single share. We're going to talk about this natural conflict between investors and entrepreneurs in a couple of minutes. But this is the basic idea between debt and equity. It's all about who gets paid first. With debt, it's the bank that gets paid first or the lender. In equity, the shareholder gets paid last. Does that make sense? Okay. Another method that a lot of people use to raise capital, you can raise capital from a bank or a lender. You can raise money from shareholders. You can also raise money from your customers. And this is a method that a lot of people would call bootstrapping. When you raise money from your customers, it means that you just try and go out and sell more product. I would argue that a lot of crowdfunding models are actually more or less bootstrapping because they're actually going out and getting money from the customers. They're pre-selling products that don't even exist yet and trying to get as much money as possible in the door from customers. So you sell a little bit and a little bit more, then a little bit more, and you have this little tiny bit of profit, and you use that profit and you reinvest it into the business and buy more of your inventory and buy more products, and then you make a little bit more money. And then you reinvest that into the business. You make a little bit more money. And then you reinvest that into the business. You make a little bit more money. And it might take a while, but eventually you start building up your profits, and it happens slowly and gradually, and then one day you're actually making a pretty good chunk of money. So this is bootstrapping. A lot of people do this because they don't want to raise capital. They don't want to give up a share of their business. And so the business, a lot of times with this bootstrapping approach, will grow very, very slowly. For a lot of folks, capital is the thing that they really need to grow their business. They might have some product that's just selling like hotcakes, and they can't get rid of it fast enough. Every bit of inventory, I got this super fancy magic marker. Everybody in the world wants one, and I can't even hold on to it long enough because as soon as I get one in stock, it's out the door. The problem is that I don't have enough money to buy that inventory, and I can't get good terms with a supplier and so forth. I have to pay them in advance, and then they send it to me. So maybe in my mind there are a lot of ways around this, by the way, but in my mind I need a lot of money so that I can buy. This is the problem in my business. I don't have enough money to buy a lot of inventory. If I had a lot of money to buy inventory, then I'd be able to sell it really quickly and make a ton of money. So instead I sell one marker today, and then 2 markers tomorrow, and then 3 markers the next day, and I grow slowly. But if I could just get $1 million in the door, then I could sell 1 million of these markers, and I'd make a ton of money really, really quickly. And so this is the idea, to think through if you have a capital need and if you'd be able to deploy that capital to be able to very, very quickly grow the business, or if it's something, again, the bootstrapping approach, where you essentially raise the money from your customers slowly and gradually over time.
You said there are a lot of ways around that.
Oh, sure. I mean, with inventory, if your objective is to buy inventory, there's a million ways around that. A lot of people think that they need money. Years ago, Matt and I, a lot of people always think that they need capital, and a lot of times they think they need a lot more capital than they do. We came across this guy, I think the first time we sat down with him was in Panama. I'm talking about Ben, yeah. And this guy thought he needed like, you know, I mean, way over $1 million because he thought he had to like buy a factory and outfit a factory. He's manufacturing baby bathtubs, little bathtubs for little babies. And he thought he needed all this money because he needed to buy a factory, because he thought that he was in the business of manufacturing baby bathtubs, when in fact he was in the business of selling baby bathtubs, and he could easily have somebody else do the manufacturing. And he didn't need anywhere near as much money as he thought he did, and so we were able to help him with that and reduce the amount of capital that he needed. And this is really a common problem with folks, is they really think that they need a lot more capital than they really do. Which is the next point I wanted to make is, do you have anything you wanted to add to that? Okay. The next point I wanted to make is, yes?
Bootstrapping.
Yes, bootstrapping.
Well, particularly in Nigeria, when we're talking about bootstrapping, we're not even necessarily talking about raising money from customers, selling products, because that really doesn't work. So when we talk about bootstrapping, it's more about how much we can raise ourselves amongst ourselves. To actually, is that relevant?
How much you can raise personally within your own network and so forth. This is what a lot of people do. I've got a slide about this later, but a lot of people do generally tend to go, I mean, especially when you're young and you're looking for money, where's the first place everybody always goes? They go to their parents. People go to their parents when they want to raise money. Yeah. Oh, your personal cash. Yeah. Yeah, I mean, your first investor, you know, is usually yourself. Whether you realize it or not, you've put time into something, and that time has value. More than likely, though, you've got a lot more expenses that you put into it. You've got travel, you've got equipment, you've got all kinds of things. So whether you realize it or not, you've already actually committed some capital into your business.
The way I look at bootstrapping similar to you, in that it's just coming up with different strategies of growing the business without, even though it has capital needs, without seeking outside investment, whether equity or debt. And so using your own personal capital is often, I mean, in combining with try and fund sales and use customer money in the business. I mean, to me, using your own money is part of bootstrapping.
Actually.
Exactly, yeah. No, I would say that's right. I consider that bootstrapping too.
Yeah, sure. You hear these stories a lot. I mean, guys that, you know, they'll max out their credit cards and things like that when they try and start the business. Very risky, very, very risky, but people do it. That is also considered bootstrapping. Of course, using your own capital. The entire idea of bootstrapping is not seeking external capital, whether that's equity or debt. If you're seeking external capital, if you avoid seeking external capital, whatever you do to grow the business, whether you do it slowly, whether you put in your own money, whether you max out your credit cards and so forth, that's bootstrapping. The other point I wanted to make here is, again, don't be afraid to raise capital, but don't automatically assume that you need it. Don't be so stubborn and say, I'm never going to raise capital. If your business, particularly if you have a capital-intensive business, if you, for example, with my agriculture business, would never be able to do what we've done, you know, without having gone out and raised capital. It was absolutely necessary, because buying all that property and real estate and the farming equipment and so forth, it does require a lot of capital. And so there are a lot of situations where you need to raise external capital. If we were to bootstrap that and say, hey, I've got one blueberry plant in the ground, and I'm going to wait 5 years for this thing to start producing at maximum yield, and I'm going to take that profit and I'm going to buy a couple more blueberry plants. It would take me thousands of years to get to the point, you know, where I am right now. And so the idea is to don't go out and raise all this money if you don't need to, but don't be stubborn at the same time. You have to look at the critical needs of your business and understand, do I need capital in order to grow this? The question to always ask yourself is, would I rather have, you know, 100% of this or 60% of that. Does that make sense? And it's this real scarcity mentality with a lot of folks in their business as they cling to this idea of I must have 100% of my business, and they don't raise capital when in fact they really need it, and it keeps their business at this level. And they've got 100% of this little thing, you know, when they could have whatever, 40, 50, 60% of this great big thing. And it doesn't take a rocket scientist to figure out which of the, you know, that it's a better decision to do that.
When you're talking about shares, does that start at 100% and you're just giving up percentages, or how do you?
Yeah, if you start your own business, you own 100% of the business. And so, depending on the structure, the legal structure of the company, if you have a corporation, there's a share allotment, there's what they call authorized capital and a certain number of shares. And so you can start selling shares just like shares of Apple and Amazon and so forth trade, and there's a share price and so forth. You can actually sell shares, and each individual share you can sell for a particular price and say, I'll sell you this share of the business for you know, $5.
And that's a percentage of that.
Yeah, and there's 100 shares of the business, and I'll sell you one share. And the difference is you could sell them your own share of the business, or the company could issue new shares and sell those new shares to outside investors. And we'll talk about the differences between that and how we make those valuation calculations. Yeah.
Which part of fundraising did you use for your farm project?
Equity and personal capital as well. Lots of personal capital. I've got a couple $1 million of my own money in it. Oh yeah, and outside investors. Yeah, yeah. Gesundheit. So, when you're dealing with investors, I'll say this: when you're dealing with outside investors, particularly at an earlier stage, when you are when you've got a business, we happen to be in an environment right now where capital is extraordinarily abundant and very cheap. Interest rates are negative. People are just desperate to find some place to invest their capital. It is an amazing environment to be in if you want to raise money. This is both good and bad. I think it's turned an entire generation of entrepreneurs into deluding themselves into thinking that they're really great because they're able to raise money at some, you know, I've got an app that makes fart sounds and my business is worth $25 million. And they think that they're superstars, when in fact, it's just an obvious sign that this massive financial bubble. And there's all these people that think, you know, that think that what they're doing is really great, when in fact it's not. It's actually just really overvalued. Investors, a lot of times in an early stage, investors can be strategic partners as well. People that you bring into the business because they can actually do something for you as well. They know somebody, they have some contacts, maybe a little bit of mentorship and so forth. And we're in an environment right now where, you know, just about any idiot can write a check. There's a lot of people out there that can write a check, and they have way more money than sense. And sometimes investors can actually be liabilities. You have somebody who's not terribly smart, not terribly sophisticated, wrote you a check for $10,000. That was the last $10,000 that he had. And he's ringing you up every day. What's going on? What are you doing? Are you know, and that person's going to be a nuisance. They're going to be a liability. The right investor can actually be an asset. And if you have somebody that's really sharp, that's just strategically minded, that you can bring on and actually have some coaching and guidance from time to time from that investor. Now, of course, if you actually have expectations from an investor that there's something more than just providing capital, you really need to give them something extra. You need to give them a really good deal or something additional above and beyond, because you can't expect somebody to provide both their capital and their time and their expertise and their relationships and their network and all these things all together unless, you know, they're actually getting something for it. So, okay. Leads me to, where do you actually find investors? And again, we are in an environment where there is such an abundance of capital. There's almost no limit to the number of people out there with capital to spend. Some of you guys come from some of these places like San Francisco where everybody's a venture capitalist. And it's very, very easy to get in front of these people now. The internet makes it extremely easy. There are clubs, there are groups, there are Facebook groups, there are websites dedicated to these things. It really is easier than ever. Really is easier than ever. I'd really discourage anybody from going to family. That's usually just not a good idea because you always have to go into these situations presuming that you're going to lose grandma's money. And that would be bad. It makes, it makes Christmas dinner very uncomfortable. So I'd really encourage you to not do it. Look, there's so many of these websites. You guys probably heard of so many of these websites. And yes, there are crowdfunding websites that are out there, and there are websites that will put your business in front of accredited investors, conferences, angel networks. An angel investor, by the way, if you've not heard this term, an angel investor is generally somebody who invests in very early stage businesses. In the old days, they used to take a really big percentage. Now, because there's so much capital, they take less and less and less of a percentage. I mean, these deals that I get all the time, I mean, they're just absurd. You get some guy, again, they don't even really have a business model. They don't know what they're doing. They have no equity. They have no income. They've got nothing. They want you to give them $600,000 and take 100% of the financial risk, and in exchange, they'll give you 1% of the company. I mean, it's these sorts of things. I mean, it used to be 10, 15 years ago, if you want to raise money, I mean, you had to give up a kidney to these guys in order to do it. And they would take everything, and you would be lucky. You would be lucky because it used to be really, really, really hard to raise money. And now it really is so much easier because there is so much capital out there, and there are a lot more direct sources to be able to go through. There used to be an entire industry of guys that would go out and raise money for commission. If you wanted to raise $10 million, you'd go to one of these guys, and they would charge you oftentimes up to 10%. And they raise money that way, and that still happens to a degree. A lot of these crowdfunding sites and things like that, they'll take a commission. But there really are so many of these peer-to-peer lending sites if you want to raise debt, and banks are an option. There are some banks that are starting to sort of want to get into this business to show that they're cutting edge and things like this. So there are just tons and tons of sources. There are a lot of cases where sometimes people go to their own customers to raise money. There's a great group here. We should probably invite these guys one year. There's a venture capital group here in Vilnius, and I'm pretty friendly with these guys. And the head guy, who's their essentially chief investment officer in their venture capital fund, he had I think it was a textile business that they got right when the Soviet Union collapsed, and he was able to take this thing over for nothing. Pretty cool opportunity. And he took this thing over, but they were really struggling. It's a capital-intensive business. They had to expand. They had to buy more equipment. They needed more stock. They needed everything, and they needed money to do it. They're doing very high-quality work. And he actually went to one of his customers, who was in Italy, and he said, "Hey, come out here to Lithuania. The wall fell. We're not Soviet anymore, and come out and see what we're doing." And made a strategic partnership with the customer, and the customer actually ended up providing the capital that they needed to grow the business because it was actually a good deal for the customer. They said, "Okay, I have now a regular supplier that I own a good chunk of, so now I've got oversight of this business that's supplying what I need. I get a deep discount on it. I get a percentage of the profits and so forth." So it was actually a good deal from the customer. So if you think about it, there really are a tremendous amount of sources for capital. And it's one of those things, Craig was talking about it in his remarks. He said if you actually just spend 15 minutes a day thinking about what are the sources of capital that I can provide, if you actually dedicate a portion of your almost infinite brain power to where can I find capital, you'll come up with a lot of different options. Anything to add?
I will just say that there's been a change in the last about 9 months.
That's right.
For angel investors, I've done a lot of angel investing. The deals, a lot of angel investors have stopped. Just stopped. I mean, I stopped. I've done, I don't know, I think I've even done 20 deals on AngelList. So I've done a lot of this, and it stopped because the deals are getting ridiculous. I mean, they're not any good for anybody, and so people are starting to get worried. I mean, the people that are trying to raise money are starting to hit walls for the first time in a while. They know they have to have a better business case. By the way, I never do anything that is pre-revenue, though, on angel investing. Even angel investing, it's early stage, but never pre-revenue.
So it's been getting easier and easier and easier for years, and I agree. Sometime in the last year, I think we hit the top, and now it's starting to become more and more difficult. And can be a very good indication of where your business is at. If it becomes extremely difficult to raise capital, it's probably because you don't have a viable business model. A year ago, 2 years ago, anybody with an idea was people were just throwing money at them. Because there's this, anybody know what FOMO stands for? Fear of missing out. Yes, fear of missing out. Fear of missing out was much greater than fear of loss. And that's how you know you're in a bubble. That's how you know you're in a bubble. When people have almost no fear. I remember hearing, some of the, Mark Andreessen and these guys that run the big Silicon Valley venture capital firms saying things like, there's a lot of hope, but there's not a lot of fear out there in the marketplace. And that's a very dangerous thing to hear. So there's this no sense of, gee, what if I might lose my capital in this really risky startup. Nobody's thinking about that. What they're thinking is, if I don't get into this and they turn into the next Google, I'm going to be kicking myself for the rest of my life, and I don't want to miss out. And so they put their money in every shitty deal that comes along because they're terrified of missing out without necessarily thinking through the consequences of that. And now we're starting to see that rebalance a little bit. Not to say it's impossible to raise money. There's still tons and tons and tons of sources out there. There's really a lot of sources out there.
It may not be a problem. So part of the thing is there's so much capital that people were willing to accept worse deals. Okay, but there's Simon will talk about tomorrow with investing, I'm sure, investor psychology. Both on the seller side of equity, like the people trying to raise money, and on the buyer side, people who want to invest, there's psychology. So you have the fear of missing out really driving people irrationally to invest, okay? But then you had the entrepreneurs, the founders, thinking that they were making an enormous sacrifice for selling, their idea or their pre-revenue business for such a small amount. So their psychology was, I need to protect more of this. So they kept rationing the deals and making them worse and worse and worse. And so they got to a point where basically it got so greedy on their side that the deal, even though the investor has so much capital, and even though they're still irrational, they go, but that just doesn't make any sense. I mean, I can't even imagine a scenario where this could possibly work out. So it may just be, rebalancing that a little bit, and then it might come back up again once the deals become more reasonable.
Yeah, that's possible, but you're right. We are starting to see a little bit of a rebalancing in that. So it's not to say that it just crashed and there's no source of this whatsoever, but I think we reached sort of peak insanity in the venture market for now, for angel investors and even venture capital funds to say, okay. And I think a good indication of that is probably Uber. The Uber valuation was going up, 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 and then it peaked. And the last investment they had was when the Saudis came in, and it was at the exact same valuation they had previously. It wasn't this huge uptick in the Uber valuation. And so I think that's probably a pretty reasonable indication of what's happening in the marketplace. Stephen, you had another question.
Yeah, you might touch on this on the investing portion we'll talk about later, but there's also, you have to be clear about what the liquidity event is too, right? And the exit.
I'm just about to talk about that. So what we're going to talk about now is how you actually pitch your business idea to somebody. So remember the Shackleton ad. You generally want to avoid that sort of thing, looking for investors for high-risk investment, zero dividends promised, long hours of complete isolation and no communication. You don't want to tell investors this sort of thing. Okay, you want to go with. You want to tell people really about your business. The most important thing you can really do is be honest about it. I can't tell you how many people try to present the business in a light that is, I would even say, irresponsibly wrong. It's easy to want to sort of present something as, what it could be as opposed to what it is. You can talk about your vision and what it's going to turn into, but a lot of times people talk in the future. They see it, and then they talk about that as if it already exists, and that's definitely not something you want to do. Look, rule number one, understand that it's not a bad thing to pitch somebody an investment. A lot of people have a really hard time with this. They approach it and they're very timid about it because they feel like they're doing something wrong. They feel like asking somebody for money is inherently evil and bad and immoral, and it's not. It's not. A great investment deal is a fantastic thing to present to somebody, And even if it doesn't work out, that's okay. It's not necessarily a waste of time. It's a perfectly reasonable thing to do. And so, you know, the most important thing, rule number one, is realize that. Get over that fear. There's absolutely nothing wrong with approaching somebody and say, I have this really great opportunity. And to be able to explain why. Did you have a question, Ernst?
No,
You're just chit-chatting. Okay.
I didn't know the understanding of one word, but we got it.
You got it? Okay. So, it might not be convenient. In many cases, it might never be convenient. If you're approaching people who have money and who are very successful, we're not exactly swimming in free time. So to kind of expect that, you know, you're going to be able to catch somebody when they're just chilling for 20 minutes straight and don't have anything to do, and you go, oh, that's the perfect time. That might not really ever be the perfect time. And raising capital as well isn't necessarily a single isolated event. It's not a, I'm going to pitch this guy, I'm going to give him 5 minutes, and he's going to write me a check, and that's the deal, and that's how it works. It can be, in many respects, a very long, extended process of continuing to tell the story and cultivate a relationship and so forth. Josh?
Let's use you give one of us 10% of the company and you need to do another round of fundraising. Does it come out of the remaining 90% or does it come out of the 100%?
That's next. That's next. So I just want to give you a few points about how to actually pitch somebody on your business. And by the way, this kind of applies no matter what you're doing, even if you're trying to sell yourself. Some of it goes back to what Jeff was saying. The most important thing is attention, and getting somebody's attention very quickly, and being able to provide a very, very quick summary. Extremely quickly. I'm raising $400,000 at a $1 million valuation to develop Tinder for old people. Okay, so I might not like that idea, but I'm going to understand in about 15 seconds exactly what it is that you're trying to do, and I'll be able to make a baseline, I'm somewhat interested in this, or I have absolutely no interest in this whatsoever, and be able to get some kind of immediate feedback on that. That's a very important thing to be able to do, to provide that to somebody. If you send these long emails and so forth and expect somebody to actually read all of that stuff, it's not going to happen. If you want to sit down and have 30 minutes to try and explain all this, it's probably not going to happen. You have to be able to get somebody's attention very, very quickly. You have to really, don't be the lazy capital raiser. Don't be the person that doesn't do any homework on your target, on your investor, on the bank, and so forth. You have to find out, do your homework and find out what motivates them. What are the kinds of deals that they've done in the past and why? What are the things that they're funding? What excites them? What are the industries that they're into? What are the characteristics of the people that they're into? Find out about them. There was a guy who was here last year, and we talked about this for probably 20 minutes, about actually doing that homework. If somebody wants to bring a deal to me, I would expect them to really try and understand, you guys all spend 5 days with me, and try and understand all the different things that I've invested in the past, and what are my sort of trigger points and the valuations that I like to see, and how the deals are presented and so forth. And that's a very important thing to do. In the same way as you would do if you were building a business, you would really want to find out a whole lot about your customer, and what do your customers want, and what are the needs that they have to have fulfilled, and so forth, and really do all that deep dive homework on your customer. Before you can sell anyone on anything, you really need to try and understand them. This is the way it works in negotiation. If you're raising money, if you're trying to sell a product, if you're trying to sell a service, you have to understand the other person. This is basic Sun Tzu. If you really don't understand the person across the table from you, you're going to lose at least 50% of the time. And so we sat there and we had this conversation, and then this is a guy who ended up in the 90%. Never heard from this dude ever again, until one day I get this Facebook message. It said, "Hey Simon, thought you might be interested in this, need about $300,000, hit me up, let me know what you think." And I'm like, was this guy, we did this for like 2 hours last year, and I was literally like specifically saying, like, these are exactly, did no homework, and I remember looking at the thing, really, why would you think I would be interested in this? And say, oh, I think you'd be interested in this. Why? Why do you think I'd be interested in this? What do you know about me at all? You're one of these assholes that disappeared. for the last 9 months. Never heard from you. We've never had a conversation. You didn't talk to me while you were in Lithuania. You're one of those guys. And now you think that you know me so well. You know what I like. You know what I like to invest in. You know all this stuff. And then you're gonna throw it out to me and sort of expect me to go through. I mean, it was offensive. I was offended. I was disappointed. I felt like I had failed to get through to this young man. And, I went ahead and opened it, and of course the deal was shit, everything about it was shit, and it clearly had not paid attention to any of this stuff at all. Get to know your investor. Get to know the people that you're reaching out to, because at a minimum you'll just look foolish if you don't. And must always know the person who's across the table from you, what makes them tick, what they're interested in. Simultaneously, you also have to know your own business extremely well. And as you may see later in the hot seats, a lot of people have certain ideas about their business that might not actually be reality. And before you go out to other people to try and raise capital, you have to have a really locked down idea of what it is. Before you actually ask somebody else to trust you, that you have the skills as a business manager to be able to take this idea, turn it into something, grow the company, generate more and more revenue. To be able to convince somebody of that, you have to, again, have this clearly identified problem, this clearly identified solution, all the steps and processes in between and everything that you need and why you need the capital and so forth. And a lot of people just think, oh, I need $1 million. I got to go build a factory and all these sorts of things. And no, you don't, because you haven't really thought through all those things in the business. You haven't designed all those things yet. And you just rush to this idea of, oh, there's a rich guy, I'm going to go ask him for money. And I'm going to ask him the time on top of it. Everybody has a different way that they generally like to be pitched. The things that Matt likes to see and the things that I like to see. There's probably a ton of overlap there. I might like to see some other things. I know Jeff probably likes to really dive deep into the numbers and things like that. And so everybody's got different things that they like to see. Generally, a lot of things, and one of you guys mentioned it before, but one of the things that, there are several things that I would encourage you to put in, and you can always read your audience and try and get to know the things that they do like to see, and even try and find out things that they've invested in before. And then you can approach those companies and find out, hey, what did you present, and how did that go, and what was the situation like? Again, do your homework, and you can find out what was presented. But there are a lot of things that usually almost everybody wants to see. People obviously want to know about the business, how the business is going to make money. People often ask questions like, who's your customer? And these are things that you really do need to understand. Your revenue model, and be able to articulate and defend your revenue model. If you have, again, the more results you already have, if you're talking about your revenue model, if you're talking about your marketing strategy, if you have a very clearly defined marketing strategy and you're already doing it and you're executing it, and you can come to me and say, okay, here's the product and here's who we're selling it to and here's the problem we're solving and here's the way we're marketing it. We've got this funnel built already, and we've tested some media buys, and we're buying Facebook ads, and here's how they're converting, and our cost per acquisition is this, and we're making our first sale within 3 days, and it's this much, and then we have this upsell and so forth, and go, oh wow, okay. So it gives me a greater sense of, you're already trying this, you got some things that are working, and makes me think, okay, I can invest a little bit more money in this, and we can see how that continues to go and grow, and you've already demonstrated some level of competence, and that makes it a lot lower risk. Another thing that you would want to discuss is exit. I always like to hear people's versions of exits, mostly because I find it entertaining. Because everybody thinks that Amazon's going to buy their business for $100 million. And they're just not. They're really not. Yahoo might buy your business for $100 million. Not anymore. I had a buddy who, one of his best friends was pretty high up in Twitter, and basically said that at Twitter, like fairly low-level management had the authority, had like $10 million buy authority at their level without having to go any higher. I mean, a guy who was like really low-level management. So there are a lot of different exits out there. People talk about being acquired. People talk about going public. People talk about mergers and all kinds of things. But at the end of the day, what I always like to hear about is how, I like to hear about profits, I like to hear about cash flow, because if you have a strong, profitable business, you have every option to exit that's available to you. That's the only thing that really matters. Are you building a business that's actually profitable, that's growing, that's productive? And if you do, then you can't really lose. Okay, sure, you're generating a lot of cash flow, maybe you go public at that point. Maybe somebody comes along and buys you because they're really interested in the assets that you built, they're interested in the cash flow. Maybe you just hang on to it forever. You've got this great business that's growing, and they take all these profits that they generate every year and they pay it out to the shareholders. They go, here you go, here's your dividend check for the year. I go, great, thanks, Jeff. And I put that in my pocket. And that's fine too. Who cares? You know, you're making money every year. And so for somebody like me, it doesn't really matter as much. Some people are really focused on going public or getting acquired, these sorts of things, and that's perfectly fine. But if your whole model, if your whole idea is we're never going to make any money, our whole goal is to have, negative cash flow, we're going to lose money, and in 3 years, Amazon's going to buy us. You're foolish. You're foolish. Okay? You have to build profitability into your model. You have to have a model that generates revenue, and quickly, and scalably. And you have to have a model that generates profit. Because if you don't, you're just going to be out of business. And I'm constantly astounded when I see companies that raise money, at tens of billions of dollars, and they lose $700 million a year. Airbnb and Uber and all these guys, they're worth so much money, and yet they just keep losing tons of money. And to me, I don't invest in those sorts of things. I always like to invest in things where there's a very clear cash flow model, revenue, profit, and okay, great. If somebody comes along and wants to acquire the business, cool, I'm happy with that. But you want to be able to communicate this to the shareholder, and I think the greatest sense of comfort that you can provide is, okay, look, we hope to get acquired, but worst case, we're going to generate a couple $1 million a year in net income, and you'll have a piece of that, and that's great. Anything to add?
One thing about structuring offers for anybody you're trying to sell something to, great marketing offers are all no-brainers. So if you're trying to sell anything, by the time you get to the, okay, here's the details of how much it costs, they are already ready to buy. They're in. And I think that it works the same way if you want investors too. A great offer is an offer, by the way, that you feel uncomfortable making. You feel like it might be unfair to you. That's a no-brainer for an investor. And if you're having trouble raising capital, your offer probably sucks. The business model might have problems too, but if the business is functioning and it's earning money, the problem is your offer sucks. You're not taking any risk in it. And the classic way to generate a sale in marketing is to reverse the risk. The risk is all on the shoulders of the investor. When you invest in a private business, you don't have control over the business. The business could earn enormous amounts of money and I could still get screwed. I could still be completely screwed. So tell me how this is a no-brainer for me. Tell me how I'm going to make money with this. There's no way that you're going to succeed unless I succeed. Tell me how that works. Tell me how it's going to, demonstrate how I would be a fool not to give you capital. And then, really, I know both Simon and I, you give us a good offer gets presented in front of us and we're in. And I would say it's the same with all investors. They might have their preferences of sectors and all this stuff, but when you get a great deal in front of you and you get somebody who's smart and clearly committed to treating shareholders fairly, because by the way, your especially angel investors can be your greatest ally or your arch nemesis very quickly if you don't treat them incredibly fairly. Then they get excited about doing business with you. So it should be an incredibly compelling offer. Were you going to say something?
Yeah, maybe you can give an offer of a no-brainer deal that you like.
I want to run through some of these things. So just a few things that I would, again, encourage you to include in your presentation. Again, start with a very big picture summary. Always tell them up front what's going on. Don't wait until the very end. Tell them up front what's going on. Like I said, I'm raising $400,000 at $1 million valuation to develop the Tinder for old people, and by the way, we're already cash flow positive. Okay, that's going to get my attention. I might think the idea is stupid, and that's a stupid idea. but it's going to get somebody's attention. You need to obviously be able to talk about the market and the customer. You need to be able to really explain your marketing plan and ideally show results. We've talked about this and we'll talk about this more this afternoon. There are so many ways to test your idea in the marketplace. There are so many ways to start generating sales and results depending on the business. Obviously, you know, if you have to do some capital-intensive agriculture, land acquisition, that's a slightly different story. But if you can essentially prove the concept and say, look, we've already developed a prototype, we've got 10,000 downloads, and you know, 50 of these old people are already swiping and paying us the premium price to you know, do whatever for their Tinder app. Okay, if you can sort of show that already, prove the concept, the closer you can to do that, the lower the risk is for the investor. You definitely need to talk about your revenue model, how you actually intend to generate income. Not, oh, we're going to grow the market and we're going to, you know, we're going to get a lot of eyeballs and all that bullshit. You know, that doesn't work. Talk about how you're actually going to raise money. Know what your costs are and be able to discuss your costs. You're never going to be able to know with 100% certainty, here's exactly these guys with their Excel spreadsheets, and they know 8 years from now, in January, their cost is going to be exactly this down to the penny. You're never going to know that, but you should have a really good idea, because if you don't, then you haven't thought about it enough. You haven't thought about, you haven't actually planned out the business, and to get to this level, we're going to need these resources, which is going to cost me this much. And to get to this level, we're going to need these resources, which is going to cost me this much. And so therefore, I need these resources now to get to this level, which is going to cost me this much. Therefore, this is how much money I'm going to need. And I always hate when people say, oh, how much money are you raising? And they'll say, oh, between $250,000 and $500,000. And I'm like, that's like plus or minus 100%. You know, you're 100% off there. And when you're off 100%, when you have 100% difference in your range, it just tells me that you haven't thought about it enough. Because if you really do, and you say, okay, what do you need the money for? And they say, well, you know, we got to get, you know, we have to pay office rent. I'm just using this as an example. We have to pay office rent. And I go, okay, great. What does that cost? And they go, oh, between, you know, 4,000 and 8,000 euros. Well, but like, how much is it? Just do the research. Do the research and see. And you go, oh, well, it makes a bigger difference if you say between $4,000 and $8,000, or there's this place, and I got the broker lined up and all the paperwork ready to sign, and it's 6,200 euros a month. And it's this many square feet, and it's not in a very nice place, but it's sufficient for what we need, because we're really going to be conservative on our costs. I go, okay, that's specificity. These general, what we used to call in the intelligence business, big hand, small map, when you just sort of gloss over the facts and the details because you haven't done the research, that's bad. Don't do that. Don't be that person. Okay? Come with all of your facts. Do lots and lots of research. So if you don't know, then you haven't done enough research. You haven't done enough thinking about it. When you talk about your revenue, don't say, this is $1 trillion market, and all we have to do is capture 1% of that, and we're going to be swimming in cash. Don't do that. Don't tell me from the top about how big the market is, and all you have to do is get 1%. How are you going to get 1%? You know, start from the bottom. Start from the bottom and say, we have 0 right now, and we are going to get customers, and we're going to sell them this, and we're going to grow that way. Don't say, I started $1 trillion, we're going to get 1%, we're going to make $10 billion a year. Show me how you go from 0 to 10 billion. Start from the bottom. And again, that has a lot to do with your marketing plan. And the more you can show with results and say, we did this, we tested this didn't work, so we shut that down, then we did this, it did work, and it's doing pretty well, and we think we can optimize that, and we'd like you as a shareholder because we need more capital for this. We could also use some of your marketing expertise, and so we're willing to cut you this really, really great deal and this no-brainer offer, which is the most important part, ultimately, is the offer and call to action. Just like you would do with a customer. If you're presenting a customer, you're trying to close them on the sale of that mattress, or your info product, or yourself for this new role, or you're trying to sell the artwork, or you're trying to get that donation, or whatever it is you're doing, you can give the best presentation in the world, say, we had this amazing business and this great experience and this, you know, I'm the greatest actor in the world, De Niro's nothing, and all this, and it's great. And then you end the presentation, you go, and so it's really great. You have to have a call to action. You have to ask them for the money. You have to ask your customer to pull out the wallet, to write the check. You have to make a very clear offer and be able to explain it to them. We're going to talk about that. How do we do that? Again, different ways to raise capital. We talked about debt, and sometimes you can go to an external investor and ask them to loan you money. You can go to an investor and ask them to invest and buy shares, and there are hybrid approaches, convertible debt, and things like that. We'll talk about primarily equity right now, and we'll go through some basic terminology. You've heard me throw this word out a couple of times, valuation. Valuation is a very important term. You have to know it with your business, because when you're going out and raising money, you have to be able to communicate to your investor the value. If you're saying, hey, I need $250,000. Can you give me $250,000? Okay. What do I get for $250,000? Well, you get shares. Okay. How many shares? 3. Okay. What does that mean? What does 3 shares get me? What does 3 shares get me? Okay. So if you think about that, essentially what the investor needs to know is essentially what percentage of the company are they really getting for their investment. You could say the share price is $5, just like the share price of Apple, the share price of Google, Alphabet, etc. But what you really need to be able to discuss is the valuation. The valuation is ultimately what the business is worth. Now, there are 2 important terms in this. With valuation, one is pre-money valuation and the other is post-money valuation. You should know these terms. Okay? Pre-money valuation is what the business is worth, valuation, is what the business is essentially worth right now. Post-money valuation is what the business is going to be worth after the investment. Okay, so that's why a lot of times when people say, I'm raising $400,000 at $1 million valuation for the Tinder for Old People app. And the next question is going to come out of my mouth is, $1 million, is that pre-money or post-money? Because it makes a huge difference. Anybody, where's my guys from last year? Medium rare. What's the difference between these? How do we determine? Mm-hmm.
So pre-money would be before you had that $10 million.
Yeah, so mathematically, what's the difference between these 2?
Post-money valuation, see if you could put down there. The equity percentage post-money would be down because there's more money involved.
Help them out. Huh? Say again? Yeah, more or less. The other variable in this is the amount of money or the investment capital. Okay, so essentially the post-money valuation minus the investment capital equals the pre-money valuation. So, okay, I'll take you through an example. Remember my balance sheet. I have assets and liabilities. I've got, right now, and I got my income statement. So let's say I'm running a small profit. I'm cash flow positive. I'm selling this Tinder app for old people. A lot of people swiping. I'm making some money. And so I go out and I decide that I need to raise some capital. And, you know, it's making $50,000 a year right now, but, you know, I think I'm going to be acquired by Amazon next year for $100 million. So I'm so keen on this. And all I need to do is raise a little bit more money. So in my mind, I think, okay, I need $100,000. I need $100,000. And so I'm going to say, right now, my business, I've decided that my business is worth $1 million. That's the pre-money valuation. I consulted with my anus. That's where you get the number from. You pull it straight out of your ass. Because people come up with these numbers all the time. I mean, what's a business worth? You know, what's a business worth that is losing money? I mean, I'm losing hundreds of millions of dollars a year, but I'm worth $67 billion. That just doesn't really make a whole lot of sense to me. I mean, people just sort of make these numbers up. There's a lot of, you know, you could use an income valuation approach, income capitalization. There's a lot of ways you could actually derive an actual number, but in the environment that we're in, there's not really any sense in it at all. People just assign values to this all the time. I get these emails, I mean, somebody comes to me and says, oh, I got this idea for something, and I'm raising money. And I say, okay, how much? And they'll say, $1 million. I have an idea. So they think their idea is worth $1 million. And essentially the debate between the investor and the entrepreneur a lot of times centers around this number. And I go, really? Your idea is worth $1 million? You have absolutely nothing. You've done nothing. You have no prototype. You have no sales. You have no marketing funnel. You have nothing. You have no employees. You don't have any intellectual property. You have absolutely nothing. You have an idea, and you really think that's worth $1 million. Because I don't. So this is the pre-money valuation. And again, this is something that, and we'll talk about, this is the conflict between the investor and the entrepreneur. Entrepreneurs always have this extraordinary amount of optimism. Usually it's uninformed optimism about their business and their idea, and they all think that, you think your idea is worth billions of dollars, you're going to be the next Google and all this stuff, and so, what a steal, what a great deal for me, because I get to buy in at $1 million, even though it's really worth billions and billions, and that's, there's that whole mentality. That's a bullshit approach. Because it's really not. When you have no assets, maybe even have some liabilities, you have negative equity, you have no cash flow, you've got negative expenses, that's not worth anything. That's worth less than nothing.
So it's better to be realistic than over-optimistic and present your idea or project in a very bright light.
I think you can be very optimistic about your vision and what you think it can be, but you have to be extremely realistic about the numbers. Again, the more you can, it's great to be optimistic. You say, here's why I'm optimistic, because we started testing, and this is selling like crazy, And so this is why I'm optimistic, because man, these my click-through rates on this are incredible, and people are they get to the page and they're buying like crazy, and I can hardly keep up. That's okay, great. I understand why you're optimistic, but there's a lot of big sort of pie-in-the-sky numbers about things that just doesn't work. And all you're telling to me is this person's not realistic. They're not grounded in reality. If your optimism is based on facts, I'm a lot more likely to be optimistic and excited with you. Sophia.
Is there a quantitative way to prove the pre-valuation?
Of course. Sorry, let me get back to this. So pre-money valuation, I've decided, I pulled this number out of my anus, $1 million. That's how much my business is worth. And when they give you a number like this, you know that there is no real quantitative analysis behind it, because a real quantitative analysis would be $1,082,161.12. That would be a real, that would show a real quantitative analysis. Then the investment capital is, we decide, what do we say, $100,000? I need to raise $100,000, which means the post-money valuation is $1,100,000. Make sense? Okay, so why is this important? Because as an investor, I just invested $100,000 in a company that after I make the investment is worth 1.1. So how much of the company do I own? Exactly. Most people are going to think 10%, because I put $100,000 in it at 1 million, but you would be wrong. Because when I do the math to figure out what's my percentage, it's actually $100,000 divided by $1,100,000, which is closer to 9%. What is that, like 9.09? Where's the rocket scientist? Where's Joao? I don't see Joao anywhere. I know you do it in your head. Okay, so yeah, I'd say 9%. Okay, so I own 9% of the business, not 10. Not 10. You do it based on the post-money valuation. So you take your investment capital, so your percent ownership is investment capital divided by post-money valuation. Oh, there he is. I needed your brain 30 seconds ago. Okay. Okay. Everybody understand that? These are important terms. Way more important than tangible versus intangible asset. So, so as an investor, then I'm going to be calculating this number and thinking, okay, I'm going to weigh the deal that you presented. Again, I mentioned this before. Somebody said, okay, you want me to put up $600,000, and there's no revenue, there's no nothing. You're just burning through cash. There's another actually important term to know is cash burn rate. Okay, cash burn rate's very important. You can probably even get what that means. Is your monthly expense that you're burning through cash is because you have no revenue, or maybe you have a little bit of revenue and you got a whole lot of expense. So every month you're losing money. I make 5,000 euros in sales, but I have 45,000 euros in expenses because we're just starting, and so we have to grow and grow, so we're losing 40,000 euros a month. That's my cash burn rate. So somebody says, what's your burn rate, or your cash burn rate? Say 40,000 euros. And I'm going to say, per year? You say, no, per month. We had this rather uncomfortable conversation with somebody about a year and a half ago. And I asked him what his burn rate was, and he said 250,000. And I said, per year, right? He said, nope. Per month. Per month, yeah. It's unbelievable. But I mean, that's the thing these days with these companies. They just blow through cash like crazy because their model is all about, growing market share and all these things. They just want to get there as quickly as possible. And look, there is a time and a place for that. And, especially maybe when you're first starting off, that may be the right thing to do is just say, okay, we just have to get to this point to get there as quickly as possible to establish ourselves. And in certain instances, that might be an okay strategy. But then these companies that they just grow and they become these global name brands and they're still burning cash. I mean, it's just crazy, right? So this actually has become more or less the standard. Those sorts of deals don't interest me. But again, I'm going to know, okay, I've got 9% or however much money. So you want me to put up all this money. You're burning cash, which means that's a serious financial risk to me. I'm giving you $600,000. You're going to burn through that in 5 months. At which point the business may go under unless you go out and get even more money. And so I've got 100% of the financial risk, and in exchange for that, I've got this little tiny percentage. Not a good deal for me. No thanks. And so I'm just not going to do anything. Another thing you need to know, another term you need to know is dilution. Dilution is what I think Josh asked earlier. So this is where a company has something called its authorized capital. Authorized capital is generally the number of shares and so forth that it can have at a certain nominal price or par value. Don't worry about what that means. But let's say I create a company and it has an initial capital stock of 1 million shares. And initially, I issue 100,000 shares, and those are the only shares that actually exist. Well, it means that the company can actually issue more shares. So, if I want to raise money, right, where does this $100,000 go? I'm the founder of the company. Does it go in my pocket? No, it doesn't go in my pocket. This $100,000 ends up in the company's bank account. Ends up in the company's bank account because what happened is the company issued more shares. So I used to own 100% of the company, right? Then I went to Joey and I said, Joey, I need 100 grand. I explained to him the deal. He liked it. So he writes a check for the 100 grand. I issue Joey shares. Now I own 91% of the company. Joey has now 9% of the company. And we could do that again later. So let's say a year later, I go, okay, now we want to raise money. We hit some milestone. We want to raise money again, this time at a $5 million valuation. Because now we're profitable, and now we're growing. We've got this market share and this name brand, and people know us, and our website gets tons of traffic and so forth. Now we're fairly successful. So now we decide that the business is worth $5 million. And we do an income capitalization approach. We look at the multiple of our earnings and so forth and look at what's in the marketplace. and make these decisions. By the way, there are metrics to this number where you get $1 million. There's a lot of different metrics. I think they're all unrealistic. You know, people do, you know, they'll go, oh, we value ourselves at 6 times our annual sales. Or my favorite is when they base themselves on their monthly run rate or something like that. So there are some approaches to this. The more profitable you are, the easier it is to come up with some basic market valuation of your business. So now we want to raise money at $5 million, and we want to raise $500,000, which means our post-money valuation is $5,500,000. That means everybody now gets diluted. So now Ben comes in. And Ben comes in, he puts in $500,000, which means Ben gets how much? 500 over 5.5 million, which should be the same. Right. So now Ben owns 9%. How much does Joey own? Does he still own 9%? Anyone? No. Does not own 9%. Yeah. Joey has just been diluted. It means that when new investors come in, your ownership of the company becomes a little bit smaller. Do I still own 91%? No. Now I own less than 91%. We'd have to do some math to figure out exactly how much. What is it?
Isn't that sort of changing the deal that gave the original person?
Yeah, a lot of early investors, they'll get pissed. They'll get pissed. They say, oh, wait a minute, I put up the money and, you know, now I own less. On the other hand, my $1 million or my $100,000 investment, I paid $100,000 for 9% of the company. This dude just paid $500,000. So on my mental balance sheet, I go, okay, I'm up 5 times my money right now. Now, that's just imaginary money because I haven't actually taken it out and put it in my pocket. It's not like it's sold on some public marketplace. I can just sell the shares like I can shares of Apple. But it means that the market is telling me that my shares in the company are more valuable than they used to be.
He could have sold them to me, no? And then he got an extra.
Who could have sold them to who?
First guy, Joe could have sold them to me.
Yes, Joey could have sold his shares to you. And then in that case, Joey could have said, hey man, I see you're putting $500,000 in the company. Do you want to buy my shares too? And now you can own more than 9%. You can own a lot more than 9%. You might say, hey, yeah, great, sounds good. In that case, Joey sells his shares. He puts the money in the pocket. But he might not do that because he's got the fear of missing out. So he wants to stick around for the ride. What Joey might do if he was really sharp is he would say, I'll tell you what, I'll sell you a portion of my shares for $100,000. Joey takes his initial capital, puts it back in his pocket. He's still got $400,000 worth of shares. He's happy, you know, and he continues on. He's basically got a free ride in the company. So that's what some people might do if they have the ability to do that. The problem with private companies is that the market for shares is generally extremely illiquid. You know, if Joey wants to sell his shares in the app that, you know, Tinder for old people, who's he going to go to? He can't go to the New York Stock Exchange or the London Stock Exchange and say, hey, I got these shares. They're not listed publicly on a public exchange. So we do Julie and I do this for shares of our agriculture business. If anybody wants to sell, we actually make our own market because there's enough people that know about it. We got a laundry list of investors that want to buy in. So if there happens to be one guy, he gets divorced or who knows what he needs to sell his shares, we're able to say, hey, no problem. And we put this out to everybody and say, hey, if you want to sell your shares, we can make it happen for you. Just let us know and we'll facilitate the transaction. And so that provides, another term that you need to know is liquidity for the investor. Liquidity is when the investor is able to trade his shares for cash. And that means either selling the shares because there's a marketplace, the company goes public, it gets acquired, any number of things is when the investor is actually able to realize that increase in value. Clearly, if you're able to raise money at a $5 million valuation instead of a $1 million valuation, there's a lot of value here between the two. So there is a clear increase in value in the business and hence my share of the business as a shareholder. But if I don't have a mechanism to extract that value and put it in my pocket and see it in my bank account, then it doesn't really do me any good. And so that's the thing, you have to be able to explain to shareholders in your presentation when we talk about the exit. How am I going to be able to monetize that increase in value? How am I going to see that and be able to put that money at some point in my pocket? Maybe I'll never want to. Maybe I'm just happy to just kind of keep it there forever. But it should be my choice and not yours. Josh.
When you're investing and you see that they're probably going to need another round of funding in another year or so, how does that affect your decisions and how transparent are entrepreneurs when they're trying to sell?
You should be transparent about it. If you expect to be able to have to raise more money later, you should be transparent about it. Some other terms that you need to know, there's these different rounds of funding. You'll hear people throw out terms like seed, and I was like, oh, there's a pre-seed and all these things. And so seed funding is, a very, very early stage. Then people have, there's all these terms. There's like angel round and venture round, all these, and the Series A and Series B and Series C and all these different things. And they're all for different things in your company. You need seed funding just to get you the basics, to finish out your prototype and whatever that is that people think they need seed funding for these days. Then they need Series A to achieve some basic scale in the marketplace. And they need Series B to scale even more and get bigger. And so because by Series B, they're still not cash flow positive, and they're not able to finance the operations of the business through profits. And those are the sorts of things I don't really like to see. If I see that a business is going to continually need to raise capital for years and years and years, that's not super attractive to me, but some people are into it. Venture capital funds need these sorts of things because they have to show to their investors that there's periodic market-based valuations for their business. I came in at a seed round at $1 million. There was a $5 million Series A and a $10 million Series B. And so I get to put on my annual report to the shareholders of my venture capital fund that we've made 10 times our money because we came in at $1 million and the latest round was at $10 million. But again, it doesn't mean anything because I haven't put any of that money in my pocket. So being able to... Right. It's what you call paper profits. So, okay. Talking about that. I got to get through this because we're out of time just about, right? Okay. Debt. I'm going to skip debt. Okay. So some just common mistakes briefly. One, common mistakes people make. One, not doing your research. We talked about that. Not doing your research, not knowing your investor. Two, not doing your homework on your own business. Not thinking through everything that you need and why you need the money and so forth, and not doing that research. Critical. Three, overvaluation. I think that's the number one mistake, is overvaluation. Especially, I think in this crowd, I'll say respectfully, you guys are really smart, but if you are starting a business and especially it's the first thing that you try, it might not succeed. Chances are it probably won't. And and this is not going to be the last thing that you do. You guys are everybody in this room is way too young for whatever it is you're working on to be the last thing that you ever do in your life. So, especially now, use it as a learning experience. Don't have such a huge ego that your business is the greatest thing since Facebook. And we're all going to become multi-billionaires because, you have this great business idea. And so you want to put this massive valuation on your business, say, my business is worth, $20 million. But it's not. It's just not. It's really not. And that's a huge mistake, is to overvalue your business. I think Matt pointed out pretty clearly, like, if it doesn't hurt, then your valuation is still probably too high.
Yeah, I just want to say one other thing about it. You have to recognize that there is competition for capital. Now, there's tons of capital out there, but tell me why I'd rather buy your business than buy Apple stock, which is trading at 15 times earnings right now and pays a 2.3% dividend, and they're regulated. I'm confident I'm going to get my dividend payment, and if I want to sell in any second, I can, and use that money elsewhere. Whereas my money might be tied up here for 5 years, might be dead to me essentially for 5 years, and the valuation is something is infinite of earnings. Like, why would I do that? That's stupid. It's stupid for me to put your money in that when I could put it in Apple instead. Okay, so there's tons of competition for capital. You have to recognize all of the downsides of investing in your private business from the investor's perspective so that you can craft a deal that is actually interesting to them. This baby bathtub one, I know we're out of time, so let's take 1 minute with this. That deal, he wanted too much money at first. We crafted it in such a way that because the business was just on the margins, it was definitely making money, generating revenue, basically not making money, but breaking even essentially. And, you know, it was I thought the guy was a project designer, think very highly of him, and we liked what he was doing. So, but we invested just a little. We got a quarter of the business. Quarter of the business made him sick, okay? Made him sick to his stomach. He had the option to buy 10% of it back from us in 1 year if he hit a certain metric. He also, though, in our contract, could not commit the company to an expense greater than $10,000 without our written permission. Okay? Because I want to make sure, because he could screw me anytime.
Is that a common tactic?
I think it's not. I mean, right now, I would say if you're in Silicon Valley and you're a technology company, definitely not. But I think in the real world of small business, it is. I mean, everyone wants to think they're a technology company. Most businesses actually aren't technology companies anyway. So, but for us, that was like, how do we make sure that we just don't first and foremost, we don't want to lose money.
That's the most important thing you can do is limit the risk for the investor. There's always going to be risk. They're always going to have to take risk. You must limit the risk for the investor. You have to demonstrate, first and foremost, that their return of capital before you can convince them about the return on capital. You have to be able to convince them that they will get their money back, that it's safe, before you can talk about, oh, we're all going to become multi-billionaires. I just need this $100,000 investment. Don't talk about return on capital until you can convince me of return of capital. Make it low risk. You know, other very quickly, you know, you don't have profit built into your model. You know, you don't have a revenue model. No, Amazon is not going to acquire you. So just don't even put that in your presentation. And also, do be careful about your investors. Again, not just because some idiot is able to write a check doesn't mean that he or she should be an investor in your business. Any idiot can write a check, but sometimes an investor can be a liability, and you don't want people that are ringing you up on the phone every single day, panicked, because that was the last $10,000 that they had. So you do need to be judicious about the people that you're investing in. You might have the money, but the business itself might not be better off. We're going to skip, we don't have any time for that. Okay, the last thing is, this is something I didn't mention last year. You must, if you take other people's money, whether it's a customer, a donor, or an investor, you have an obligation. There is a sacred obligation when somebody else gives you money in exchange for something, shares or whatever. You have an obligation that is very solemn to fulfill. With investors, you know, with customers, you must fulfill whatever the experience is. You must provide that product or service. And there is a very special circle of hell for you if you don't. With investors, you have now a fiduciary obligation to your investors to give everything your 100% effort. Don't be one of these people that's got, you know, 18 side businesses that you're doing, and then you want somebody to give you money, but you've got all these other things going on the side, and this is sort of the thing that you do, and, you know, once it starts to take off, you'll put more time in it. You know, you owe your investors your dedicated attention. You also owe them, go ahead, Craig.
What if it's a travel blog?
Or a blog about blogging.
Right.
Yeah.
So that's
I don't know if you're joking or not right now. You also owe your investors regular updates. And this is a huge thing that I didn't mention last year, is that once you have the money, that's not the, yeah, I got the money, and then you just run away and you never really talk to these guys ever again, or there's some sort of sporadic, you know, every other year communication. You owe your investors regular, formal, objective updates. We do this with our agriculture fund. We put out financial statements. I religiously provide extensive, comprehensive, 30-page quarterly updates to let them know exactly what's going on. The good and the bad. We screwed this up. We got this right. This is going great. We have a little bit of concern here, blah, blah, blah. These are the things that we put out. You know, I'm an investor in Royalty Exchange. Matt and Jeff and I have known each other for years. We've been friends for years. And yet even still, Matt sends out a formal update to me, his buddy, that he writes himself, updating me about the company. And we're friends. And yet he still puts out a very formal update. And I'm actually going to read you, and I don't give a shit that we're over time, because this is great. I'm not going to read you like a 30-page update that I send to my investors. But this is something, it doesn't need to be 30 pages, by the way. It can be short. But I'll just read you a few highlights of this. And he's basically saying, he starts off, he says, fellow investors, we aim to become the premier public exchange for securities of income-generating royalty assets. So, right off the bat, he restates essentially the mission of the company. Why is this important? Because there are some other people involved in this as well. We're all busy guys. We have a lot of different investments. And so, in some respects, almost a reminder of, hey, this is what you invested in, and this is where we're going. And restates that. So already I'm like, yeah, cool, and I'm excited. And then we go, and he goes on to continue with that. And then he gives you some highlights. He says, here's what happened since we launched. And then you read some statistics. We had this many auctions. We had this many new users. We had this much gross marketplace volume. And he defines some of these metrics, basically saying, here's how we measure the success of our business, and here's what we've achieved so far. Then he gives me, because this was a business that they bought out of bankruptcy, and then he gives me something to compare it to. Because if I'm not part of that industry, and he wants to talk to me about gross marketplace volume, and I'm thinking, well, I don't really know what that is, he can give me a comparison and say, well, here's what it used to be, and here's what it is now. So even if I don't understand exactly what that is, I can at least see, oh, wow, okay, there was pretty significant growth there. So now I have, again, I've anchored myself to this sense of what it used to be, what it is now, so I can see some pretty clear growth. Then he goes on and he says, our no-lose strategy. He goes on to explain in high level, here's basically what we're trying to do, the strategy of the company. We're building an alternative asset stock exchange, and he goes on to explain what that is, and he said, in the worst case, we have a niche auction platform that generates this certain amount of net income per year. That's basically what I would view as the worst case scenario. So now as an investor, I'm thinking, okay, great, that's good news. It's obviously good news to think the worst case scenario is we're still going to make a lot of money. Okay, and in the strategy, he explained to me exactly sort of how we do that. So even if we fail here, 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 and here, we can still make this much money because of X, Y, and Z. Then he goes on to sort of dive into that a little bit deeper. Here's our roadmap, phase 1, phase 2, phase 3, phase 4. We're going to do this, then we hit this milestone. Then we're going to do this, and then we're going to do this, and then we're going to do this, and by the time we get there, we'll be doing this, and we'll be making this much money. And then this was great, key lessons and next steps. You know, we're all smart guys, but we're not flawless. We're going to make mistakes. Here are some of the things that we screwed up and what we learned from the things that we did, and how we're going to take those lessons learned and improve to make sure we don't make those mistakes again and continue to be even more successful. And then here are the things that we're going to be doing next. By the way, our next steps, you know, here's what they are. We may potentially need your assistance. And so if you have the ability to do X, Y, and Z, or if you might be able to do this, or if you have some additional feedback on how you think this strategy is going to work, or if you have some suggestions, please give us a call and let us know. And that's basically it. And that, man, that ticks so many boxes, because now I have a wonderful sense. That was, I don't know, probably about 2 pages, maybe 3. I now have a wonderful sense of the business, exactly what's going on, where it's successful, what its weak points might be, if and how I can help, what's going to happen next. It's a wonderful update to get. And you have an obligation to provide these things to your investors. You know, if Matt can provide me, his friend of many, many years, a formal update like this, then you absolutely owe it to a complete stranger who has entrusted you with his or her savings and an expectation that you are going to give your 100% fiduciary attention to this to make it the best possible investment that you can. With that,
I was just saying, investors love shareholder-friendly stuff, okay? Shareholder-friendly. And I think that it's so, like, there's a chance that when someone invests in you, you might lose their money, okay? And they understand that when they come into it. But if you're communicating with them the entire way, and they understand what's going on, and you're open to input and feedback from them, at the end of the day, they will be like, that one didn't work, no big deal. And next time you do something, you can give them a call again. Because they know, because we all understand it's like some things just don't work. Sometimes we make mistakes. Sometimes the market turns against us. Sometimes funding dries up in other places. That's the way it works. But if you are a great executive who treats shareholders right, they want to stick with you. So just, you know, a lot of times things start to go bad, people go, well, we got to control information here. We can't tell these people exactly what's going on. And that will not end well for you. It won't end well.
Okay. We're out of time. We need to go to lunch. So thanks everybody for your time and attention. I will say one last thing. Well, thank you very much.